Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, we'll have full market coverage ahead as the latest read on inflation eases Wall Street's trade war concerns. Plus, we'll look at the leading candidates to lead the Fed as the search for Jay Powell's successor heats up. And we'll get the latest read on the AI trade as ASML throws some cold water on the red-hot rally. All that and much more coming up on Market Catalyst. But first, let's get a check on the markets here. We are seeing a mixed picture, whereas yesterday the Nasdaq was leading us higher. Today it is the laggard here, down right now, not even a fifth of 1%. The S&P little change, the Dow up a tenth of 1%. And this is sort of what we have seen throughout the week here, this sort of mixed to little change session. This is also somewhat characteristic, right, of earnings season. As we start to get further into earnings season, you see a lot of individual stock moves, but not necessarily as much sort of macro moves macro-driven moves in the market. But let's take a look at the bond market as well. We had been talking this morning about yields kind of ticking up, but they're going in the opposite direction today as we saw PPI relatively mild. But what's interesting in PPI, producer prices, is that services inflation ticked down, but goods inflation was not necessarily as benign, as mild. Nonetheless, seeing the 10-year down 4 basis points to 4.45%. Well, the EU's trade chief will head to D.C. on Wednesday for trade talks with his U.S. counterparts as trade tensions mount. That's according to Politico. The visit is rather last minute, coming after Trump issued a surprise threat of 30% tariffs on the bloc over the weekend. A deal between the two was, quote, tantalizingly close before President Trump's latest threat, according to the BBC. Joining me now to discuss, Ed Mills, Raymond James Managing Director, as well as Dory Wiley, Commerce Street Holdings CEO. Gentlemen, thanks for being here. So, Ed, as we try to follow the tariff back and forth here, how likely do you think this EU deal is to get done in the coming days?
Julie, I think it's actually pretty likely to get done. What we're telling clients here at Raymond James is that what President Trump likes to do is as he's getting close to a deal, he ramps up the pressure. He kind of doubles down. He sees the opportunity to maybe get one or two more things. And so what we've told clients at Raymond James is if you see some nasty letter, if there are some negative headlines, don't view that as something is going poorly. It might be actually an indication that it's going well. And he wants to claim that he escalated it. And if he gets the deal, he'll go back and say, the only reason we were able to get this across the finish line, Julie, was because I put the pressure on to get it over the finish line. So to me, bad news sometimes is actually pretty good news.
Well, it's interesting that you say this because Greg Ip, writing in this morning's Wall Street Journal that President Trump is winning the trade war. I guess it depends on how you measure winning, right, and where we are. But I'm curious what your assessment is.
Yeah, so the way we've been viewing this is that there's a lot of conversation in this market about the potential taco trade. Trump always chickens out. But I do think that there is a bit of a misnomer there as it relates to we're probably going to see at least a 10% baseline tariff for most countries. Some of these trade deals are getting closer to 20% as a baseline tariff. There is a view that the trade weighted average could be 15%. And so, Julie, if I told you on January 20th that we'd be going into kind of the summer here with a 10, 15, 20% tariff on most countries, I don't think you would have believed me. I know that when I talked to clients here at Raymond James that they weren't prepared for that. So I do think he's really good about resetting the bar and then negotiating something lower. That's not necessarily chickening out. It is about resetting expectations.
Right. And certainly it feels like the market's expectations have been reset, Dory, right? Because we have not seen a lot of reaction to these latest tariff headlines, even though the overall tariff rate is certainly going to end up higher than it was before this Trump term, right? So I'm curious how you're thinking about trade, how much you're even factoring it into your investment decisions right now.
Well, it does factor in, and we haven't seen all the effects yet, but the market is learning, right? So in March, it had a full-fledged panic and reverted back to its horrible memory of Smoot-Hawley and the Depression and thought the word tariff meant the end of the world. And now the market's realizing, no, that it's not. And Trump went through this before in 2018, and he won. And he's been stacking up wins, just like he said a while ago. He's been stacking up wins all year. And he's a good negotiator, and he doesn't just negotiate for negotiation's sake. he negotiates from a position of strength because we don't have fair trade, and that's what he's trying to get to. And I do think he's going to get there. Now, we haven't seen all the effects of these tariffs come into the market yet. We're starting to see it creep in furniture and toys and sporting goods, et cetera. And it's going to continue. We'll see more of this into August and whatnot. So it's going to affect the economy going forward and inflation numbers. And I think that's why you see the Fed kind of pausing, and it to much of Trump's frustration. But I think there's still some question marks out there. Now, it doesn't mean that those are long-term issues. I think Trump is playing all of this for the short term for fair trade.
And of course, that's even assuming that this is the outcome that is desirable economically, which of course is Trump's position. I want to ask about sectoral tariffs also specifically, Ed, because he's talked about pharma tariffs, he's talked about semiconductor tariffs. What do we need to be sort of watching there?
Yeah, so on sectoral tariffs, we're expecting that these investigations are wrapping up probably close to the end of this month, and we'll start getting some of those details more fully next month. And it does seem like on the sectoral tariffs, pharmaceuticals is going to be first. After that is semiconductors. We're not done with the investigations. I'm told that there could be a handful new investigations. What we're seeing on the sectoral tariffs that we're expecting to be announced here, Julie, is that they probably are going to have some really big numbers, but plenty of time for implementation. And that implementation, if there's progress towards things, that total number, once again, will come down. The final thing we're telling folks at Raymond James is that sometimes these sectoral tariffs are a way of avoiding other tariffs. So in the example of the aeronautics sectoral tariff investigation, I think the Trump administration here is doing that to come up with a conclusion that that's going to have a zero tariff. And if you're subject to a sectoral tariff, you're not in on the otherwise reciprocal tariffs. So there's a lot of nuance here. I get asked the most about semiconductors because that has such a huge impact of things coming out of China.
Yeah, most definitely. I also want to ask about what's going on with economic data and the Federal Reserve, guys. Ed, what are you hearing there in D.C., right? There is now some reporting out there that Kevin Hassett is kind of the front runner to potentially take Jay Powell's place at the Federal Reserve. What are you hearing, and what's the kind of vibe in Washington around this decision?
So, Julie, the way I view this is that President Trump always loves competition. He came to some of his most recent national prominence by having the Apprentice show. And so my expectation is that President Trump is going to keep multiple people in the running. Kevin Hassett certainly is in there. Kevin Warsh is in there. I put Christopher Waller, who's already on the Fed board, as well as Treasury Secretary Bessent. I'm watching to see if there's an opening on the Fed, if a governor steps down like Michael Barr, now that he's no longer vice chair for supervision. Does one of these individuals get onto the board? I'm also watching for Waller, as there are rate decisions here in July, in September. Is there going to be a dissent? You generally don't see dissents among Fed governors, but as you're auditioning for that role, showing that you would be much more dovish is something that President Trump is going to be looking for and could move him up the list of potential Fed chairs come May of next year.
Yeah, I think the Apprentice Federal Reserve edition is something that no one asked for, guys. I don't know, Dory, like in terms of market reaction to all of this, we've seen rates kind of remain range bound here as we get numbers like CPI yesterday and PPI today. But do you think at some point that this competition is going to start to really come to bear in the bond market?
Yeah, I think we have a showdown coming. Most people in the marketplace want to preserve the independence of the Fed. And when I say that, I mean that both ways, not just from Trump's standpoint, but from the Fed standpoint. And obviously, the Fed is, in my mind, Powell's been a little political on some of his rate cuts early last year. Having said that, the market has always anticipated, for the last couple of years anyway, more rate cuts than actually should have happened or did happen. And I think we're falling into that trap, and so is Trump as well. I'm kind of a wait and see kind of guy right now. I do think the next Fed chair is going to be one of those type of interviews. Hey, I'm Donald Trump, and I believe this, and if you believe this, I'd like to have you as Fed chair. That points to Hassett being the being there, and I think that's going to get some criticism from the market. I think we need that independence. We need good independent valuation, I think cutting too soon could be extremely dangerous when we all know that our deficit is out of control, our debt is out of control, and we don't want to become Venezuela.
Guys, I want to turn to another topic. There's a lot going on, obviously, so thanks for bearing with me to cover a lot of ground here. Another big story out of Washington is the so-called crypto week, right, in the House of Representatives, with lawmakers attempting to pass that trio of crypto-related bills. They had been running into some roadblocks. The president says he's confident he's going to get the votes. That happens this afternoon. Do you share that confidence, Ed? Do you think he has the votes? And kind of how does that then play out in the crypto industry?
Yeah, Julie, the votes will be there. This here is a kind of procedural issue. If there was just a standalone vote on what's known as the Genius Act, which is the stablecoin legislation that's already passed the Senate, my expectation is that final vote on that bill is going to be fairly overwhelming in the positive direction. And my bet is that goes to President Trump's desk by the end of the month. Part of the debate here is what are the other bills that are being considered? There's 2 other pieces of legislation. There's always a desire to get a commitment from the Senate that once the House passes this, they will spend some time on that. That's going to provide more regulatory infrastructure for digital assets generally, as well as making sure that the Federal Reserve cannot issue a U.S. Digital coin. The market impact to this is not only in the stablecoin realm in kind of favorable for digital assets. I think the real reason why this is getting passed is that Secretary Besson has said that this could be as much of a $3.7 trillion market for Treasury bills. They need more purchasers of those Treasury bills. I'd probably take the under on that dollar amount, Julie. But as we are refilling the Treasury General account, as we are looking at growing debt and deficit, getting a new buyer for a lot of our debt is something that is actually pretty positive from a rate perspective, or at least that's what the market is hoping.
All right, Ed, great to see you. Thanks for joining us. Dory's going to stay with us because coming up, we're talking banks with Dory Wiley, both the reaction to what we have heard thus far from banks as well as the potential for consolidation in the sector. Stay tuned. You're watching Market Catalysts. Bank of America, Goldman Sachs, and Morgan Stanley reporting strong second quarter earnings boosted by trading activity as tariff uncertainty fueled volatility. Joining me now once again, Dory Wiley, Commerce Street Holdings CEO. Dory, I was just checking on the stocks here, and they're trading lower, which is maybe a little bit surprising here, given this sort of blockbuster trading results. What do you make of the results, and what do you make of the reaction to the results?
Well, I think investors are probably realizing that all this was priced in as well already. I mean, we got pretty good reports from everyone. When you look behind the numbers on these big money centers and whatnot, most of the excitement is in the investment banking, particularly the equity trading, the fixed income trading, et cetera. IPOs are picking up, M&As have picked up, and so the revenues have picked up from there. Now, as far as banking loan growth and deposits, yeah, that's there, but it's modest. And notice net interest income is not really expanding for some of these banks, which is an asset liability issue. As rates moved up, they adjust the loans up faster than they do the deposit rates. The deposit rates are catching up, particularly on wealthy clients who now want a healthy return on their money market accounts versus nothing. And that I think that's putting a little pressure on that interest income. And when you look at these banks priced, particularly JP Morgan at 16 times earnings, I think as a bank investor anyway, what you do is you start looking at smaller banks, at regionals and community banks, and you see net interest income expanding. So as an example, Huntington came out with an announced deal, but they talked about their net interest income expanding 3% for the quarter as a prelude to their as part of their announcement. And I think you're going to see that in these other banks. So that's part of the reason why I think there's a little bit of a sell-off, because the pure bank part is it's good news. It's not bad news. Credit quality is holding up, but it's not great news. The great news is in the investment banking, and that was already priced in. And of course, that is more cyclical and should be a lower multiple.
Right. I want to get to the regionals a little bit more, but before we do, I'm curious to ask you about the consumer side of banking too, because even as you say, maybe the net interest margin wasn't great, the rhetoric around the consumer side of the banks was decent, right? You had Brian Moynihan of Bank of America saying consumers remained resilient. You had Jamie Dimon sounding a little more positive. What do you make of those comments?
Yeah, I noticed they both kind of went out of their way on that, and I'm getting mixed signals from the market on that, particularly in the housing. Housing is down, pricing is down, delinquencies are up. Your mortgage payment is double what it was 5 years ago. So there's still a lot of pressure out there on the consumer, and the American consumer in particular, drives everything for the whole world, not just here. So we do have to watch that. I thought those comments were interesting and positive from those banks, but I'm still a little bit suspect on quite how the consumer is really doing.
Let's get to those regional banks, because if you're not sure how the consumer's really doing, what is the implication then for some of these more pure play regionals?
Well, a lot of them they're not as retail bank oriented as the big banks. Now, Huntington's a pretty good sized bank, so they have a good mix of retail, but they're very diversified in commercial and real estate and everything else. And these smaller community banks tend to be the smaller the bank, the less consumer focused it is. It doesn't mean the consumer doesn't affect them, but it's more in an indirect way. So I like these smaller bank plays. The pricing multiples are much lower at 12 or below, down to 10. And they have faster growth rates, net interest income expansion. And like Huntington's acquisition of Veritex, they're able to acquire one another for growth, which the money centers can't do.
And you advised on that acquisition that you just mentioned, Huntington buying Veritex. It's $1.9 billion. It was an all-stock transaction, and it gives Huntington 30 branches in Texas. Do you think we're going to see more of those sort of smaller kind of bolt-on deals in the industry?
I do. The M&A business for banking has been really slow the last 2 years. And part of that is regulatory, part of that is economic uncertainty, leadership out of Washington. There seems to be more direction, seems to be more of a green light from regulators. Approvals have sped up. We've had deals in our pipeline at Commerce Street, doing M&A for banks, all of a sudden finally getting approved that have been hung up in the Fed for a while. So I think there's a general sense of optimism, and we're getting calls from many banks around the country and locally about increased activity. And so I think I'm sure other firms are too, I think you're going to see a continued increase in that activity going forward for at least the next 6 to 12 months.
Dory, great to see you as always. Thanks for joining us.
You're welcome.
Coming up, big tech in focus. We had ASML sort of with a tepid forecast, and we also have Jensen Huang continuing to take a sort of rock star tour of China. We've got all your markets action coming up. Stay tuned. You're watching Market Catalysts. 1 hour into the start of trading, let's go live to the NASDAQ to get a read on the biggest factors moving markets today. Joining us now, Brooke DePalma. Hi, Brooke.
Hi, Julie. Good morning. What we're seeing here is the Dow and the S&P 500. S&P 500 really bordering the flat line, but the Dow certainly moving just a touch higher. If you take a closer look at the YF Interactive here, we saw a slight bit of a rally when the Dow jumped more than 100 points at the open based upon those solid bank earnings that we got. Now moving down a bit, up just 30 points here in the open. The NASDAQ moving slightly lower, of course. So far this month, we saw the NASDAQ hit a record high, and so now we're trying to hold on to that momentum here. The S&P 500 really flat today. If you take a look at the intraday, not really moving just too much. I do want to take a look, though, at crypto stocks. That's something I have my eye on as this crypto week, so-called, is underway on the Hill. What we're seeing there is a bit of a rise when it comes to stock, rather Bitcoin, like Ethereum, up nearly 5%. We also have other players like Solana, also up more than 3%. Bitcoin has seen a rally here. If you take a closer look over the past 5 days, not much of a move, but really month to date, Bitcoin got a rise up 8%. And I do want to note there that if you take a closer look, you jump right into the interactive here. We've seen over the past 5 days, Bitcoin really cross that key 120,000 threshold. And that certainly got lots of momentum moving into this week. As you can see, that happened on Monday as we were making way into this so-called crypto week, as investors are really trying to understand and digest how exactly the bill bill, particularly the Genius Act, could really come into play when it comes to this regulatory infrastructure that the sector has been hoping for. Raymond James, Managing Director at Mills, had just told you on Market Catalyst that the final vote on that bill, the Genius Act, he thinks will be overwhelming. And so lots of momentum there, perhaps already baked in. But if you take a look at the crypto stocks, they've certainly seen lots of momentum coming into this bill. That's month to date. If you take a look at the intraplay right here, we're seeing Circle bounce up nearly more than 9% rather. And if you take a look year to date, we've seen quite the momentum. Of course, Circle, they went public back in June. And what we've seen over the course of this company on the public markets is really an uptick here. We know that they're down from that record close in late June, on June 23rd, now sitting around $213. But year to date, Robinhood, Coinbase also getting lots of momentum as investors are really looking for this regulatory environment, really getting some infrastructure here in place. And that's causing lots of momentum here in the Bitcoin market.
Now let's get to some of today's trending tickers. We are watching Unity Software, Ford, and Silver. First up, Unity Software shares surging to a 52-week high after Jefferies raised its price target on the stock to $35 a share from $29. The analyst there saying that he expects to see continued improvement in the company's AI-powered ad platform Vector. That's over the next several quarters. Unity shares have rallied from April lows like many other tech plays. Brooke DePalma is still with me from the NASDAQ here. And, you know, Unity has been a fairly volatile stock here, so it's interesting to see this call out.
Absolutely. Fairly volatile indeed. I was reading a note from Wells Fargo this morning, and they said that Uni management has executed well against the early phases of a turnaround story. The stock now trading at less than 20 times 2026 EBITDA. They said that feels rich for a business in transition. But if you take a closer look at the stock on the Yahoo Finance platform, year to date, the stock is up nearly 48%. And we're seeing this stock rise to a record high. It's up 14% today. And so lots of momentum behind what this could turn out to be in this turnaround story. Certainly, we're seeing investors pleased with the momentum this morning.
Yeah, definitely pleased with the momentum this morning. If you do look at a max chart of this thing, it's quite a different story that it's telling, because it's definitely like when you talk about the turnaround story, it's on the back of the collapse that it saw in the stock back in 2021. But let's get to our next one here. This is an interesting one. Ford recalling close to 700,000 vehicles due to the possibility of cracked fuel injectors that could leak, causing a fire risk. Now, so far, Ford has issued more recalls in the first half of 2025 than any car company has in an entire calendar year. Ford says it's going to incur about $570 million in costs from this recall alone. So the shares, Brooke, are under a little bit of pressure today.
Yeah, absolutely. Ford shares down about 2.5% in early hours trading here. But this has been quite the year for Ford. Of course, back in April, they were certainly impacted by the impact of Trump's tariffs, or what could have been the impact on the auto sector. So many different components of these vehicles come from many different regions across the globe. And so that certainly hit investors, optimism about the stock. We saw them hit that record low. Of course, now, if you take a look at the stock price, it's only at $11.25. Back in April, the stock was only at $8.44 for that April low. And so investors are certainly trying to understand and digest what exactly this could look like as far as this recall goes. The company did say that this will be a special line item within their upcoming Q2 report. And so keep a lookout for that, but not a lot of momentum over the course of the past year. That stock is down more than 20%. And so certainly, not much going on there. And at an $11 stock, investors are certainly being a bit uneasy about where this story could go from here.
Yeah, it is. I mean, it's bounced a little bit year to date. Year to date is doing better than some of its competitors. But yeah, that, to your point, that longer term chart doesn't look too great. Finally, let's talk about gold. It's not the only precious metal getting some love this year. Silver has rallied over 30%, and Citi expects that run to continue, hitting $40 an ounce in the next 6 months. Meanwhile, the bank issuing a more cautious stance on gold. Both of them down a little bit today, Brooke, but it is interesting to see silver start to creep more into the consciousness here.
Certainly interesting to see after we saw those record highs with gold. Back in late April, as we saw investors try to find these safe haven areas within the market, we saw gold rally to above 3,500. And now we're seeing silver hit the highest price in a decade. If you take a closer look, silver is up 30% year to date. It's above that $39, or rather hit above that $39 threshold as of yesterday. And we're really seeing investors try to find these safe havens within the market. Certainly commodities have gotten a lot of attention, especially around President Trump's tariffs, but we have seen gold remain this safe haven asset. Certainly one note saying out this morning that the recent rally, once again, in silver is not necessarily a reflection of gold, but it's sort of on its own there. But once again, gold really rallying here. It's hitting its highest price in a decade. Before that, the highest price there was back in 2012. And so certainly one to keep an eye on, Julie.
Yeah, definitely. Thanks so much, Brooke. And you can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Well, European chipmaker ASML throwing cold water on yesterday's chip stock rally. The company walking back its 2026 growth forecast, citing trade risks and global tensions. Joining me now, Patrick Moorehead, Moor Insights Strategy Founder, CEO, and Chief Analyst. Patrick, it's good to see you. So, ASML, a maker of these lithography machines that are basically crucial in the chip making process here. They're seen usually as sort of a bellwether or an indicator. So what does it tell us that they are seeing this tariff risk in their inability to give better guidance?
Yeah, so this one's very straightforward. Essentially, with tariffs, you might have a U.S. chip manufacturer, an Intel, a Samsung, a TSMC, who might have to pay 20 to 30% more for a machine that's a couple $100 million. And what they're doing is they're holding back and waiting to see what happens. I think this is a short-term issue. The administration put a moratorium on chip tariffs, but they didn't put a moratorium on chip manufacturing tariffs, which is a bit ironic given the administration's desire to want to have more homegrown chip manufacturing. So it's literally playing against itself right now. But I think cooler heads will prevail at the White House, and I think we'll see some relief.
Well, and I mean, you're the perfect person to ask about this stuff, Patrick, because you really understand these supply chains. I mean, to take the other side of the point you were just making, like the ground is only just being broken, and in some cases not even that, on some of the chip manufacturing facilities in the U.S. Like, what's the lead time on an ASML machine if you're going to order one?
Gosh, a lead time in an EUV machine could be 6 to 9 months.
Got it.
The good news is that there's a lot of work in process. They don't not start building until they get the order. They have a good idea of, through their customer forecasts, what they're going to need. And I will guarantee you that TSMC has a demand. Sure, ground machines aren't being pulled into the new Intel facility in Columbus, Ohio, but facilities in Tyler, Texas with Samsung and in Arizona with TSMC will require these machines to be able to build chips for companies like AMD, for companies like Nvidia that have already signed pretty large deals with TSMC in Arizona, including Apple.
Gotcha. Okay. So eventually you think these orders are going to come through. You mentioned Nvidia, so let's turn to that company, right? It seems like Jensen Huang has taken a bit of a victory tour in China after getting signals from the U.S. government that they're going to be able to sell the H20 chips there again. Is there a risk, though? I mean, they're basically in the political crosshairs here. So how are you thinking about his ability to navigate that? Because, he only has so much control over the company's destiny in that way.
Yeah, Jensen's in an interesting spot, right? He has to make the U.S. happy in terms of investment there, and then he has to make other countries, including China, feel special as well. But you can't give too much attention to China Otherwise, people in the U.S. Might be raising their eyebrows. So he's actually walking that fine line very well. He's really good at the dance. And yes, there is a risk that things can change next week or the next month, because chips and technology have become an absolute bargaining chip, and China has rare earth metals that they are flexing their muscles with. Literally, our US manufacturing is dead in the water with automobiles and jet engines and electronics if we can't get access to China's rare earth minerals. I will say, though, I think this is a good sign, right? We've had a quid pro quo. We enabled access again to EDA from Synopsys and Cadence, offering the H20. And I think it's really the hawks in Washington that are having issues with this. Why they're having issues with a detuned H20 is a little bit surprising to me. Lutnick got on TV and talked about it being 4 generations behind. That's not exactly accurate, but it's close. It's close enough. So yeah, I think it's just a bargaining chip, and there could be some risk down the line in a Trump administration, until that final deal has been signed. And even after that, I mean, Trump signed a deal with Mexico with USMCA and came back and then added additional tariffs on top of that, even after the deal that he had cut before.
Patrick, always good to see you. We're going to be watching all of this back and forth and these issues as always. Appreciate it.
Thank you.
Coming up, much more markets action ahead, including some news from European automakers. We'll be right back. French automaker Renault cutting its margin guidance for the year, citing a challenging macro backdrop. Here with the context, senior autos reporter Prof. Subramanian. Down. Wow, that is quite a hit to those shares.
Yeah, I mean, stock's getting hammered here. I think it's the worst day since March 2020. So,
wow.
We're talking about pandemic days, and they cut their full year forecast here, right? So they cut operating margin to 6.5 from 7, free cash flow to 1. They cut it to 1 to 1.5 billion euros from 2 billion. They're saying, facing pressure from the, EU demand and China competition, both in China, obviously, but also in Europe now these days, more and more of these Chinese EVs coming at lower prices. In addition, they named their Duncan Minto the interim CEO. I think they're still reeling from the fact that their former CEO, Luca De Meo, went to luxury giant Kering, which was kind of a big surprise. He was an auto guy, and he just basically switched total industries there, right? So that still was an overhang. And I think that it's really sort of, you're seeing that right now, that the severity of that move right now we're seeing in the stock.
And Renault is not, so you and I have been talking in recent days about European automakers and the tariff effect, right? But Renault, you don't see too many Renaults driving around the streets of America, right?
Right, unless you have some sort of classic Renault. But yeah, because they don't operate in America, and they're thought to be insulated from all the tariff war stuff that Trump was unleashing on the Mercedes and Porsches of the world, which were really suffering. And Renault was thought to be a safe haven automaker for investors, at least in Europe. But what you're seeing is that even they are having problems with their own domestic market in China. So even then, without the tariff exposure, there's still kind of a little bit of troubles there for Renault, which is interesting given the fact that the other European automakers are really struggling.
Right, exactly. But I guess that surprise, that thought that they were insulated, is part of the reason they're down so much, because it was a surprise for people. Ross, thank you. Appreciate it. Coming up, the next big milestone for crypto ETFs is in sight. That's next on Market Catalysts. The House is expected to vote on the Genius Act, with President Trump saying on social media the bill is expected to pass, and House Majority Leader Mike Johnson will call for a vote, he said, as early as possible. This all comes as enthusiasm for crypto assets extends to ETFs, with the IBIT ETF potentially exceeding $100 billion in total assets under management this summer after it became the fastest ever ETF to reach the $80 billion milestone. I want to bring in Matt Kaufman, Calamos Investments head of ETFs, for this week's ETF report, brought to you by Invesco QQQ. Matt, thanks so much for being here. Obviously, we have seen as crypto prices have moved higher, we have seen sort of an explosion here. Ever since we got these spot Bitcoin ETFs, there has been huge growth. What do people need to know as they look through this landscape and look at the big growth that we have seen?
Yeah, you showed that IBIT stat of $85 billion.
Yeah.
It wasn't just the fastest growth in any ETF we've ever seen. It was remarkably so. It was 5 times faster than anything that we've seen in the ETF space. It's been a remarkable growth trajectory. I would say it's a nod to the adoption that we're seeing in Bitcoin today. It's not just a speculative asset, which we've seen a wildly volatile ride for Bitcoin, but that volatility is starting to come down a little bit. We're starting to see a maturation of the space, and I think it's being shown in the flows. You're seeing more than $100 billion tied to Bitcoin. That's the largest one that we're seeing, more than $2 trillion market cap. That's where a lot of the flows are happening, is in Bitcoin. But you're right, it is a remarkable story.
And we were talking to an analyst from CoinDesk yesterday who said that even with that huge growth in ETFs, that only something like 5 or 5.5% of all Bitcoin is in ETFs. So what does that imply about the room for further growth?
Yeah, we're seeing a lot of financial advisors calling and saying we need a Bitcoin strategy. Historically, the volatility has kept a lot of people on the sidelines. That's not necessarily the case today. There's ETFs in the marketplace that just don't give you spot Bitcoin exposure, but can give you exposure with protection. That's great for advisory platforms because now they can use that traditional framework that they're used to using on their portfolios, but now apply it to Bitcoin and actually get improved risk-adjusted returns. We're seeing about 1 in 5 Americans owning crypto today. So you can see some adoption curve, still happening there. But again, I think the large movers are going to be the financial advisory communities, the trillions of dollars sitting inside those portfolios that now are looking for Bitcoin exposure.
So when you talk about that sort of protected or hedged Bitcoin exposure inside some of these ETF wrappers, we've talked to some other folks recently who have some of these buffer sort of products.
Sure.
At Calamos, how does that work? How do you protect against too much downside or too much volatility?
Sure. Yeah, so Bitcoin is a large liquid asset now. There are ETPs like IBIT, and so those are that's the framework that we look for to be able to deliver protected exposure to an asset. We've done it on S&P 500, on NASDAQ, Russell. You can do it on Bitcoin now. We launched the world's first protected Bitcoin ETFs back in January, and we did it with 3 protection levels. You can put 0% at risk. So think about a risk-free rate, but getting no downside, tying your upside to the price of Bitcoin. We did 10% at risk or 90% protection, and then a 20% at risk product or 80% downside protection, and you get about a 40 to 50% upside on that product. So there's suites designed to deliver 1-year performance tied to the price of Bitcoin. We're seeing a lot of advisors start to use that in their portfolio. And then we just published some research as well regarding the use of those ETFs or those strategies inside of a portfolio. Most of those spot Bitcoin exposures, those firms might say put 1 to 2% of your portfolio into Bitcoin. The reason that it's only 1 to 2 is because of that volatility. It might increase returns, but it increases risk as well. Here, you can sell out of equities, move into the 20. Maybe you're selling bonds into the 90, making cash and putting that into the 0, and actually improve risk-adjusted returns. So I think Bitcoin not only is a large asset, but now advisors have a way to apply it to the portfolio that can actually improve performance and risk.
And Matt, when you look at those products, they're still relatively small, right? Both Calamos and at other places. What do you think? We've obviously seen a rapid growth in interest in crypto assets. What do you think is going to be the tipping point for some of these protected ETFs?
Yeah, if you look at a lot of they're called 13F filings, you can see who owns a lot of the spot Bitcoin products. And we're seeing a lot of retail investors and a lot of institutions. Some of those big hedge funds are some of the largest owners. It's not like they're owning spot Bitcoin outright. Sometimes they're doing what are called basis trades, where this IBIT is serving as a foundation for some of their strategies. The financial advisory is that big middle, that community's the big middle that has yet to fully move in. And they're looking at how to actually apply Bitcoin to the portfolio. So we've raised more than $100 million in our suite just in over a few months here. The adoption has been good. The demand, I would say, is outpacing the current adoption, and that's largely a framework of platform adoption, getting approved on a lot of platforms, going through due diligence processes, compliance committees. So we're in the weeds now, but that's largely how you get those funds approved, and I think that adoption is going to only grow. We're at the beginning of that hockey stick.
Matt, thanks so much. Appreciate it.
Thanks so much.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, we'll have full market coverage ahead as the latest read on inflation eases Wall Street's trade war concerns. Plus, we'll dig into the health of the IPO market and where companies are choosing to go public. Plus, is the recent stock rally a healthy one? Today's stocks in translation, honing in on market breadth. All that and much more coming up on Market Catalysts. It's 90 minutes into the start of U.S. trading. I'm Julie Hyman. Let's get a check of the markets here. We do see things still a little changed today. Mixed picture with the S&P and the NASDAQ very slightly lower, the Dow very slightly higher here. We're also watching the bond market, and there on that side of the equation, we had been seeing a move in yields, but we'll put a pin in that for now. Because let's talk about what's going on with Jay Powell. The search for Federal Reserve Chair Powell's successor is underway. Earlier today, frontrunner Kevin Hassett joined the growing chorus of Powell critics, saying the Fed has been very, very slow when it comes to rate cuts in an interview on Fox Business. The National Economic Chair also adding that inflation data has been, quote, fine. Joining us now for more, StoneX Senior Advisor and Yahoo Finance contributor Jon Hilsenrath. Before we talk about Hassett, though, I want to bring up a story that just came out from CBS News, which is reporting that President Trump on Tuesday was meeting with some House Republicans, a group of House Republicans, and he asked them what they thought if he should fire Jay Powell. The people in the room said, yeah, maybe you should. And he kind of said, well, maybe I will. Obviously this has been going back and forth. And Powell has been very clear that he does not think that the president has legal grounds to remove him before his term is up.
Right. All right. How do we read all of this? There's a lot going on here.
Yeah.
Right? So when the president was choosing a Fed chair to succeed Janet Yellen back in 2018, he loved to do this. He loved to have these very public conversations with people about who should I pick? Should it be this person or that person? Ironically, the person he settled on then was Jerome Powell. So now, obviously, he regrets the choice. There's this undercurrent of adversariness going on right now with Powell because of the Fed's renovations, $2.5 billion project to renovate the Fed buildings. Hasn't been renovated since the 1930s. The Fed says this is long overdue. His adversaries in Congress and in the White House say there have been cost overruns. You haven't been straightforward and honest about that. Therefore, we can fire you with cause. So that's where this is going. Do they threaten to fire him with cause? Ultimately, I think that the people who are going to decide whether Jay Powell keeps his job or not are in the bond market. Because what we saw back in April when the last time the president was threatening to fire Powell was bond yields rose. People were concerned about the stability and independence of the Fed, and the administration backed off. So if we see the bond market reacting again to this, I think once again they'll back off. Frankly, I think all this drama about Powell, we're just going to have it for the next year. What I think is most important is the next Fed chair and not the current Fed chair. So it's going to be very hard to get Powell out of there, even if they try to fire him. He said he's not going to leave, right? So Fed policy is going to be what it's going to be this year, but next year he's putting somebody in place who he says he expects to cut interest rates very aggressively. And so whoever becomes the next Fed chair is going to have some implicit promise to live up to. And again, we come back to the bond market. Is the bond market going to tolerate Fed rate cuts when inflation is around the Fed's target. It's a little bit above the Fed's target, but it's not screaming that it needs to be a lot lower.
Yeah.
So ultimately, it's the same thing with trade, I think. Ultimately, it comes down to, is the bond market going to tolerate what they're doing? And if the administration sees this tolerance coming back on them, then I think they back off.
So we talked to Ed Mills in the last hour of Raymond James. He's a policy analyst there. And I want to play for you what he had to say about this whole competition for next Fed chair.
Mm-hmm.
You generally don't see dissents among Fed governors, but as you're auditioning for that role, showing that you would be much more dovish is something that President Trump is going to be looking for and could move him up the list of potential Fed chairs come May of next year.
So as you say, the qualification is you say you're going to cut rates.
Right, yeah. I think he was talking about Chris Waller there. So a Fed governor who's now sounding more dovish, like he's willing to cut interest rates. I don't know where the president is going to land on someone like Chris Waller. So Chris Waller is a Fed governor. The last time the president picked a Fed chairman, it was Jay Powell, who was a sitting Fed governor who he didn't know. So, you know, to me, the more obvious candidate is Kevin Hassett, who knows the president, who's been close to the president all the way back to his first administration, stuck with the president after 2020. I mean, that's why Kevin Hassett's name is out there right now.
But to your point, isn't Kevin Hassett the least independent choice? Wouldn't he be the choice that the bond market would be most displeased with?
Well, so, I mean, that's the important question, right? So if he's the least independent choice, then one would think he would be the candidate that the president would be most pleased with.
Right.
Right? So, and then it comes back to, well, is the bond market going to tolerate that? So with Kevin Hassett, I mean, he's a real and respected economist. He's been around for a long time, Harvard trained, worked at the NEC, worked at the CEA.
Is he still as real and respected, though, as he has gotten kind of further into the Kool-Aid of this White House?
Well, so like this, like all of these policy debates come down to psychology debates, right?
Yeah.
So is he going to be independent? Is he going to make a promise to cut in? Like, we have to see how all of that stuff plays out. To me, the interesting allegory for Kevin Hassett is Arthur Burns.
Right.
So Arthur Burns was and this is the Fed chair in the 1970s.
Right.
Arthur Burns was very close to Richard Nixon. He was an advisor to Richard Nixon. He was the head of the CEA in the 1950s. He became the Fed chair, and President Nixon turned on him very fast and pushed him very aggressively by using threats of firing and stacking the Fed against him to try to get him to ease policy going into the 1972 election. I think Kevin Hassett he's got qualifications to get the Fed job because he's close to the president. In terms of doing the Fed job well, I think it could be a real challenge for anyone who gets this job. It's going to be a challenge.
And when is the last time, if ever, that we had really active dissent within the Fed? In other words, if Kevin Hassett gets the job and he wants to cut and the rest of the board does not want to cut,
yeah, right.
When is the last time we've seen that dynamic?
I mean, this is a fascinating dynamic. It's not unheard of. I covered the Fed after the financial crisis in 2008. There was a lot of disagreement on the Fed board. One of the people who disagreed with the chairman was Kevin Warsh, who now might also get the job. But a lot of regional bank presidents back in 2008, when the Fed was doing QE1 and QE2 and QE3 and Operation Twist, and I can go on. There was a lot of dissent there that Ben Bernanke had to manage. I think in this case, that was economic dissent. That was dissent on the economic policy grounds. I think here you run the risk of a lot of political friction. I'm watching very closely the regional Fed banks. So, we know about the governors, but as soon as one of those regional Fed bank presidents in Chicago, an Obama appointee, in San Francisco, in New York, if they start dissenting against a new Fed chairman's motions to cut interest rates, then I think people in Washington are going to be saying, why are these these unelected presidents from private banks telling the president what the interest rate policy should be? I think there's going to be a political storm next year over these regional Fed banks.
Okay, so one final question for you on this whole issue. Usually when the Fed president's term is up, he leaves the board of governors. He doesn't have to. His term can, in this case, Jay Powell could stay on.
Right.
Usually they leave. Is he less likely to leave because he thinks he needs to be a bulwark against what's going on?
I think Kevin Powell, I'm sorry, I had Kevin Powell. There's everyone is named Kevin. I think Jay Powell is ready. He's counting the days.
He's kind of over
until he can leave. But I think he doesn't want to get ahead of himself and promise or commit to leave, because then he loses a little bit of leverage in this whole process. I mean, and we get into some sequencing issues here, right? Because there's a Fed governor position that opens up in January. So whoever becomes the next Fed chair might have to take that governor position if Powell isn't willing to leave his spot. I think Powell would like to leave and probably is just hoping and praying that this process is smooth, but we're not seeing many indications that it's going to be smooth. But again, I think there's a lot of drama around Powell right now. I'm more interested in who his successor is going to be and how that successor is going to manage what's going to be an intense storm from the president, regardless of how close that successor is to the president right here, right now.
Well, as I called it earlier, the Apprentice Federal Reserve Edition, even though the markets might not want it, it is entertaining, we must admit,
it's entertaining. And, you know, I should say, despite all of this drama, the bond market is so far taking it very calmly. I see these analogies with the 1970s. I wouldn't be as calm. You know, I think there's a lot of pressure that calls into question whether the Fed's going to keep inflation at that 2% target. So far, the bond market is saying it's not that worried.
Well, we know how the market works. It's calm till it's not.
Exactly.
So we'll see.
Right.
All right, thanks, Jon. We got much more markets action coming up, including a discussion of the IPO market. You're watching Market Catalysts. The London Stock Exchange is losing some of its shining stars. Drug maker Nvidia plans to cancel its listing on the London Stock Exchange at the end of July. Fintech firm Wise also announcing plans to shift its primary listing to the U.S., and there are reports that AstraZeneca may do the same. Meanwhile, new activity in the country has been muted. In the first half of 2025, the UK and Ireland saw just 7 IPOs, according to data from EY. Joining me now to discuss is Rachel Gehring, EY America's IPO leader. So why are we seeing this movement, this shift of companies, particularly from UK to the US?
Well, largely with what's happening kind of in the broader Europe region with their economic recovery and the slowness there. Whereas in the US, we've got deep capital pool, a lot of investor interest, attracting a lot of companies outside of the US to the US, which we've been seeing a good number of deals in the first half so far of 2025.
It's also been interesting to hear some of the rhetoric as the EU trade discussions are going on. Now, this doesn't apply to the UK necessarily, or maybe you can tell me if it does, but there's been some talk about the EU trying to become more business friendly. Are you optimistic about that? And then what effect would that have on listings going forward?
I'm definitely optimistic. I mean, what's happening here in the U.S. is impacting relative to the conversation around tariffs and trade is definitely having a impact, globally. And Europe is not immune to that. A lot of companies and the markets really uncertain about where these tariff conversations are going to lead. How is this going to land over the coming weeks and months? Europe, focusing on what they can do within their locally to drive more activity. When you look back to last year, Europe commanded over 27% this time last year of global IPO proceeds raised. Fast forward to today, they're at 10%. So definitely a slower economic recovery impacted by tariffs and other geopolitical uncertainty. So it's something that they're going to have to continue working through over the coming weeks and months.
And here in the U.S., or I guess even just globally, is the major obstacle to the IPO market really opening back up in a more dramatic fashion? Is it that tariff uncertainty?
I would say uncertainty is the theme generally, whether you're talking relative to tariffs, whether you're talking about policy here in the U.S., even immigration policy and what that's in the impact to the labor force, broader geopolitical instability, just broader uncertainty continues to be the theme, impacting not only in the U.S., but around the globe. So something that everyone is continuing to monitor. But when we look at how the first half ended, particularly the month of June, very, very optimistic. We had great deals here in the US in June, fueling optimism into Q3 in the back half of 2025.
Something sort of bigger picture I want to ask you, maybe it's more of a philosophical question, which is, why do companies have to go public? In other words, we've seen a huge growth in the number of private companies and the size of companies that stay private, right? I think of the SpaceX's of the world, et cetera. If their investors are, if the private markets are sufficiently liquid that their investors are not pushing them to go public, they're not. And is there anything wrong with that, for lack of a better word? I mean, what does it say about how the system is working?
Yeah, no, that's a great question, because no, I don't think it's a signal that something is wrong. The IPO market is necessary. Companies of a variety of sizes need this access to capital, and there's a lot of benefits of going public from a brand perspective, a governance perspective, but then also that access to capital and access to liquidity in making deals, both locally and globally. But to your point, companies are staying private longer. The private markets are healthy. There's investors very interested, particularly when you think about AI and other particular companies and sectors and so forth. So companies are staying private longer. We're seeing that by just looking at the IPOs coming to market today. These are large companies IPOing over the last 18 months. That's been the trend. These are mature companies, stable, having a history of performance and profitability that's driving confidence from investors. So we're seeing kind of that pathway in staying private longer benefit into the IPO market, where we're seeing larger deals than we have in historical periods.
So I guess, maybe that longer term trend won't change too much, but we'll still see an increase at some point of companies coming to market. What's going to crack it open more? Where geographically do you think that's going to happen the most, and maybe in what sectors as well?
So I think the stability of the market needs to maintain. So that uncertainty, those topics that we talked about just a bit ago, the more clarity around policy, trade, tariffs, immigration, and so forth will help drive activity in the market. We're seeing large companies come to market. We need more growth-oriented companies as well to drive more of that traditional volume. I don't know that we're going to see kind of a complete opening. It's going to be continued gradual recovery. We're optimistic that 25 is going to continue to improve over 24, and that's going to continue as we look to 2026. But it's going to be a gradual recovery in the IPO market.
Thank you so much, Rachel. Appreciate it.
Thank you.
Coming up, we got some of today's trending tickers, including one Tesla bull doubling down ahead of earnings. We'll be right back. Two hours into the start of trading, let's go live to the NASDAQ to get a read on what is moving markets right now. Joining us, senior reporter Brooke DePalma. What are you seeing, Brooke?
Good morning, Julie. Certainly 2 hours into the trading day, we're seeing investors relatively calm this morning after that producer price index came in unchanged year over year. And they try to understand how exactly Trump's tariffs will move through this in the remainder of the year. Taking a closer look at the major indices on the YF Interactive, what we're seeing is the NASDAQ and the S&P 500 trying to hold on to that momentum after the NASDAQ hit a record high on Tuesday's trading session. The NASDAQ, if we take a closer look over the past 5 days, we saw the index hit a record high once again on Tuesday. Now moving back a bit after that. The S&P 500 also trying to do the same after we saw that index also reach a record high over the past month, and now moving slightly lower this morning in these early hours of the trading session. But taking a closer look at what exactly is moving in terms of sectors. Right now, we have healthcare, we have real estate, we have communications services really leading the charge here in this market, but also lagging behind at the end here is energy. That that sector moving down about a percentage point in this early hours of trading. But I also want to take a look at cryptocurrency. We've had our eye on it all morning. And after a slow start to the day, after Bitcoin hit those record highs, we're now seeing a bit of a buzz here. Bitcoin up 3% once again after that cryptocurrency hit a record high, crossing that 120,000 threshold. Also, I want to take a look at Ethereum. That cryptocurrency up nearly 8%. But if you take a look month to date, and particularly take a look year to date, what we've seen is Ethereum really rebound here. We've really seen Ethereum cross over the past 3 months from that 1,500 mark all the way to what now is slowly reaching or nearing that 3,500 threshold. And that's largely because we're seeing the House of Representatives right now, the so-called Crypto Week underway, the Genius Act that really provides more regulation around cryptocurrency come into play here. And that has investors excited. So we're keeping a close look on Bitcoin, Ethereum, also Coinbase, Circle. We also are keeping a look on Robinhood. All those companies that trade around these cryptocurrencies are ones that we should watch, especially in its intraday trading as that crypto week is underway, Julie.
Now let's get to some of today's trending tickers. We're watching Nvidia, Tesla, and Bitmine. First up, Nvidia CEO Jensen Huang has sold another $37 million worth of the company's stock. That's according to an SEC filing. This sale of 225,000 shares is part of a previously disclosed plan from March for Huang to sell up to 6 million shares of Nvidia. So far this year, he has disclosed sales of 1.2 million shares overall of the chip maker. So with me, Brooke DePalma here. Investors watch this stuff, right? But given how the shares have done and given sort of how these share sales are planned in advance, I don't know if it's a signal or not for the shares.
Yeah, what we're seeing right now in early hours of trading, if I take a closer look, Nvidia moving down about roughly flat here. But what we've seen, if you take a look over the past 5 years, is, believe it or not, Nvidia was at just $11 a share back in 2020. Now we're seeing these shares hover around those record highs of 170. Of course, it hit a high yesterday at $171. But this stock has just had so much momentum. Over these past 5 years, you can really take a look at this chart. This AI revolution has really led to this increased optimism, this bullishness around Nvidia and those other AI stocks. And I was reading today that Jensen Huang now is above Berkshire Hathaway's Warren Buffett when it comes to that Bloomberg's billionaire index. And what I find so amazing is Jensen Huang not only leading this AI revolution, but what I love most is that if you look at his LinkedIn, he still has the fact that he's a Denny's dishwasher back in the late 1970s, early 1980s. But really, the momentum's there for Nvidia. Jensen Huang certainly certainly seeing the benefits of that as well.
Yeah, let's talk about Tesla shares too. They're on the rise after Cathie Wood's ARK Invest has closed a purchase of additional shares in the automaker. The move comes ahead of Tesla's second quarter earnings and after a rocky year for Tesla that's seen the Magnificent Seven name down over 20%. Longtime bull Wood's price target for Tesla, $2,600. I mean, every time I talk to her about it, Brooke, she is one of these people who believes in the sort of AI future of Tesla, even though right now it makes most of its money from cars.
Yeah, she's definitely very bullish on this idea of the robo-taxi. She actually said in a recent interview that robo-taxis will account for 90% of the value of the company in 5 years, she believes. And so she's definitely very bullish about this autonomous vehicle market and what essentially it could become. Of course, you really can't get over that noise that has been around Tesla. Of course, Elon Musk's role in the Trump administration, that has certainly taken a toll on the stock. And if you take a look year to date, what we've seen here is the stock up relatively, let me take a closer look at the YF Interactive here. What we've seen so far year to date is this stock come into play, or rather, let's take a look over the past year. We've seen the stock up 24% over the past year, but really over the past month, they've been trying to hold on to this momentum, especially around that end of June rally that we got a bit there around this autonomous vehicle testing. But there's been lots of fluctuation in the stock, lots of confusion around where Elon Musk stands here. And also we've heard about multiple executives leaving Tesla. And so investors really trying to weigh all of these, but of course getting a bit of optimism here, especially after this latest announcement from Cathie Wood here.
And finally, Brooke, shares of Bitmine Immersion Technologies rising double digits after billionaire Peter Thiel's venture capital firm, Founders Fund, disclosed a 9% stake in that company. Bitmine recently brought Tom Lee of Fundstrat on board as the company shifts from being a Bitcoin miner into an Ethereum treasury, and shares moving up 15% today.
Shares certainly moving higher, now up about 17% in early hours trading here. And what we've seen this sort of correlate with is that run up of Ethereum. Like I said earlier, Ethereum really has had quite the run in the past few months. In the past few months alone, over the course of 3 months, we've seen Ethereum jump from about $1,500 to now crossing that or nearing that 3,500 threshold. And largely that's been in line with this environment where we're getting more regulation around cryptocurrency. And that certainly has investors excited. Of course, if you take a name like Peter Thiel, we also know that he's the co-founder of PayPal, of Palantir. And so there's definitely optimism running into this stock today.
Thanks, Brooke. Appreciate it. Some developing news that we are following now. Bloomberg News reporting that President Trump is planning to fire Federal Reserve Chair Jerome Powell soon. They're citing White House officials. This comes after the president reportedly spoke to lawmakers on Tuesday about removing the Fed chair. Stocks and the dollar extending losses amid the news, which had also been reported by CBS. I'm also seeing a headline from the New York Times that President Trump has drafted a letter to fire the Fed chair. Joining us now to talk about all of this and more is Scott Sperling, THL Partners co-CEO. Still with us is Jon Hilsenrath, StoneX Senior Advisor and Yahoo Finance contributor. Scott, it's good to see you. And I was already planning to talk to you about Fed independence, and now we are seeing this situation sort of heat up here. What's your reaction to this situation and the effect it could have on rates and therefore down the line on your business?
You know, I would say that Fed independence has been built into the legislation creating the Fed and has been respected for decades. I think it's important for the country to have an independent Federal Reserve that can make decisions separate and apart from what the political environment may call for. I understand the president believing that inflation is under control and rates should be low, particularly because the weight of interest payments on the U.S. budget is enormous. It's now become second only to defense spending among the non-entitlement parts of the budget. And obviously, if you can reduce the nearer term rates by a couple hundred basis points, that would be highly advantageous in that regard. On the other hand, I do think that long term, this country is best served with an independent Fed. I'm the last one to be able to give you the legalities of whether or not the president even has the authority to fire the chair of the Federal Reserve. I'm sure that we'll see lots of people take that to court, and we'll see how it plays out. I would say that the other part of it is I hate to see the distraction. I think the president and the administration has done a wonderful job of eliminating areas of uncertainty through the passage of the tax bill, the so-called Big Beautiful Bill, the ability to reduce the burden on the both the business community and across the board on taxpayers is very positive, and that was a very important element in that bill. The deregulation that had been promised has been coming through. I think it's a major positive that we have not yet seen the full effect of, but that the market, I think, is anticipating. I think all of that in an environment where there's a lot of excitement about the nature of productivity gains that will be enabled by this revolution of generative AI is very exciting. So having something that creates more uncertainty and is a diversion that digresses from all the positive moves that the administration has been able to undertake, I think is somewhat unfortunate.
Yeah, Jon, we obviously been talking about this story over the past several days, really, and now it does seem to be heating up. There does seem to be at least, the possibility that the president is going to try this. I mean, how you mentioned earlier that Powell has said he wouldn't leave. Like, how does that even play out?
Well, so what the president seems to be lining up to do, and what Republicans in Congress seem to be lining up to do, is to try to fire Jay Powell for cause. And the cause that they've focused in on is cost overruns in the renovation of the Fed's Eccles building in Washington, D.C., and Powell's testimony about those cost overruns and what's going into the renovations. This is going to get into some element of a theater of absurd, how much of the marble in those buildings was replaced with new marble, how much was refreshed old marble. Let's clear all of this away. I think, to me, here's a number that you could focus on, 4.6%. What is that? Right now, the Treasury, 10-year Treasury rate is under 4.5%. It's rising as this talk about firing Powell. As we speak, the yield on the 10-year Treasury rate is rising. When it gets to 4.6%, they stop threatening to fire Powell because the market rejects it. I mean, I think we've seen the same thing. I never liked the talk of the taco trade. Trump always chickens out. What I call it is market tolerance testing, MTT, market tolerance testing. The president is going to push the market as far as he can on things like tariffs and on things like the Fed. He's going to push the market as far as he can on getting Powell out and getting short-term interest rates lower. But what we're seeing is the Fed cannot cut the short-term interest rate and deliver the president what he wants unless inflation is low and stable. And the bond market is going to reject a move on interest rates and a move on the Fed chair that it thinks could be inflationary. That's what we're seeing today.
Right.
And I think if we see the 10-year yield continue to rise, if it goes over 4.6%, then all of a sudden these trial balloons deflate. If it goes to 5%, then they really start worrying.
Yeah.
That's exactly what happened in April, and we're going to see it again this week.
Okay, so Scott, as you mentioned, all of this is a distraction. Like, President Trump, take the win. You got the big, beautiful bill through. We're making progress on the trade negotiations. So what does all of this mean for your business and for deal making? While you do still have some level of trade uncertainty, certainly. So what does this do to the ability of deal making if rates are going to push up a little bit and with all of this noise happening?
Yeah, I would say that if you look at where rates are today, they're not unusually high. If you take the longer picture, they've been much higher for more extended periods of time in the 40 some odd years that I've been doing this. So I don't find the rates today to be highly problematic. And in fact, for other reasons, the supply of credit is actually incredibly strong right now. We're seeing that coming from an enormous influx of capital into private debt, so-called private debt, and the fact that the big banks have basically said we're not going to lose market share to the private debt providers, so we're going to pursue that aggressively as well. So the world today, in terms of financing acquisitions of companies, financing investment, is actually quite attractive. Spreads are incredibly tight. The terms are quite good. So what we don't want is what was just described, which is that the Fed loses control of rates because the market itself is too worried about what's going to happen long term. We have to refinance over the course of a number of years $37 trillion of debt, and that's growing. So we need to have confidence so we have strong buyers, particularly of our 10-year and beyond debt. And the thing that I think many of us worry about is that we're going to lose control. The Fed is going to lose control of that, just given the sheer magnitude of the amount of debt that needs to be refinanced. And so having every bit of certainty and giving the market some assurance that we are still paying attention to inflation and the ability to control monetary excesses is really incredibly important.
Julie, can I jump in on that? I think there's a couple of really important points here. So the president wants lower interest rates in part because there is so much federal debt out there. Congress just re-upped for budget deficits annually of 6% to 7% of GDP. The Fed, in the end, doesn't control that interest cost. The Fed controls the short-term interest rate. The interest burden on that debt was created by Congress and ratified by the executive branch over 25 years, and the Fed cannot get us out of that. If it lowers short-term interest rates to try to accommodate a lower interest cost on the debt, then long-term interest rates are going to go up. So, all the Fed can do is manage inflation. It needs to keep its eye on the ball of 2% inflation. We're close to 2% inflation right now, which is why interest rates are generally lower than they have been in the 80s or the 90s. But if the Fed loses that narrative, then the whole interest structure goes up. It doesn't go down. And that's why I think the Fed's 2% objective is so critical. Now, on that 2% objective, we're near it. We're not below it. So it's not screaming for much lower interest rates right now. It's imperative that the Fed stays on, and that's what Jay Powell says he's trying to do, stays on that 2% objective.
And, again, from the point of doing deals, we're in a really good spot right now. It's been very slow because of all the uncertainties, but people have gotten comfortable that there will be a reasonable solution to the entire tariff set of issues. And certainly, again, the deregulation and the tax policy that now has much more certainty around it makes it a better environment from a deal-doing perspective, and importantly, from the perspective of investing in the United States in a variety of different businesses. Right now, we have enormous investment that is being talked about. It's almost all in the area of things that are backing and providing infrastructure for generative AI. There are lots of other places. Life science is another example of where there's still a lot of uncertainty given the NIH funding situation.
Right.
That is probably more powerful as an employer than almost anything else that we have in this country, life science and healthcare. And so providing a little bit more certainty there will be helpful. We're on that good track. Let's not get off of it or be diverted.
Scott, I just want to ask you lastly, through the lens of all of the businesses that are in your portfolio, since we're talking about inflation as part of the Fed conversation, what are you seeing in your businesses, right? We got CPI and PPI over the past couple of days, yes, but I always like to talk to people who are in it, right, in terms of what you're seeing.
So like many in our industry, we invest in things that are tech-enabled or technology businesses or healthcare businesses. So we haven't seen a lot of inflation flow through into our cost structures. Where we have seen it, we've been able to mitigate, as many in the industry do, those sorts of things. You can get out in front of it. I think the bigger issue is the people that that our companies serve, the customers for our software businesses and our other tech-enabled businesses. That's where we're still, a little bit anxious about the longer-term picture, or I should say intermediate-term picture. I will say that I think economic activity, which we were pretty worried about a couple of months ago, as far as we can tell, has continued to pick up quite strongly. So I think people have acclimated themselves to certain levels of uncertainty, particularly on the tariff side and about the potential for inflation there. But again, let's not throw anything else into it.
Guys, I feel so fortunate to have you both here to talk about this as it is unfolding. It's really great to have your perspective. Scott, Jon, thanks so much.
Thank you.
Thank you.
We got much more markets action coming up. You're watching Market Catalysts.
On Monday, the S&P 500 closed down with a small loss of 0.4%, but only 49 stocks closed higher, while 453 closed lower, which was the worst showing for a loss this small in at least 3 decades. In this edition of Stocks in Translation, we're going to take a look at market breadth and market internals. Now, first, let's take a look at the definition of market breadth. It refers to how many stocks are participating in a move, whether to the upside or to the downside, and there are many different ways to measure measure it. So first up, I'm going to take a look at the S&P 500, which is in the top part of this chart here. And in the bottom, we have the percent of member stocks that are above the 200-day moving average. Now, this is a key level that technicians look at that tells you at a glance, should you be bullish or bearish? So I'm going to circle here. This goes from 0% to 100%. And I want to highlight some of the bear market lows that we've had here and the advances off of that we've seen. Here's 2011 after the S&P downgraded U.S. debt. Here's after the bear market of 2016. Here's 2020, that early COVID rebound. Then we had a bear market, and then there was another one in late 2022. But what I'm showing you here is that rebound in 2022, which kicked off the current bull market, that was not very strong. And we've seen breadth here kind of oscillate and not really break up the way that it has done in the past. So you put it all together, this chart is not saying that there's a lot of internal strength in the market right now. And in fact, if you've been paying attention to the headlines over the last few years about all the mega cap dominance, the Mag 7, that's not a surprise. So this just kind of reflects that reality. But what's a little bit concerning is that after this near bear market miss that we just had post-Liberation Day and this rally, we've barely gotten above 50%, and that is just not historically strong. So now I'm going to show you a different measure of this. This is the S&P 500, again in white, and here it's on a log scale. And then in green, I'm going to trace this out. Might be a little bit hard to see here. This is actually the S&P equal weight divided by the market cap weight. And so this tells you when it's higher, this means that more stocks are performing. And in fact, this huge surge that we're seeing above that came off of those 2009 lows, that was when we had record QE stimulus, the first QE stimulus in the US, a lot of fiscal stimulus as well. We saw a lot of breadth and participation from all the members in the stock market. Now, what we're seeing here, you can see we've had this steady decline over the last 2 years of this bull market, so that it's actually at the lowest levels since 2009. That was the end of the global financial crisis. And you could actually go a little bit further back into the beginning of the century. It was lower coming out of the dot-com bust, but this is historically low right now, and I find that concerning as well. I have one more measure that I want to show you here. You might have heard of the advanced decline line, and this is simply for the S&P 500, which we have here in white. The green line is the advanced decline line, and let's say on any given day, let's say there are 300 stocks moving to the upside in the S&P 500 and 200 to the downside. Well, you take that 300 minus a 200, and that equals 100. You take that total every single day, the winners minus the losers, and you add it to the total. And that gives you this line that usually tracks the underlying market. Now, sometimes there is a divergence, and what I want to point out here is that even though we're at record highs right here, we are also experiencing record highs in this indicator. So one of these three indicators I've shown you in these boards right now is showing some confirmation of these record highs in the S&P 500, but most are saying that there is a divergence. I'm going to close here with a final chart. This is the S&P 500, put this on a line chart basis, and this is year to date. And what I want to show you is we have those February highs right here, and we are just above them. And my concern is that with all these divergence measures, if we were to go back below this red line here, those prior highs, then we would have a situation where we're probably going to maybe test some of these lows in here. So tune into Stocks in Translation for more jargon-busting deep dives. New episodes on Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. More Market Catalyst is ahead.
Oracle co-founder Larry Ellison has officially surpassed Mark Zuckerberg to become the world's second richest person with a net worth of $251.2 billion. It's according to Bloomberg's Billionaires Index. The jump is thanks to the recent rally in Oracle shares. The stock is up over 40% year to date as investors pile into names they believe will be winners in the AI arms race. Joining me now on this, Yahoo Finance tech editor Dan Howley and market domination anchor Josh Lipton, who has followed the tech industry closely. Guys, thanks for being here. On the one hand, Larry Ellison probably doesn't like to be second in anything, Josh. On the other, maybe it feels good for him to edge out Mark Zuckerberg from what we know about the sort of egos of some of these tech billionaires.
Yeah, what's incredible is you look at the move in this stock, Julie, and I was talking to Dan about this off camera. Remarkable move in that stock, and analysts are still pretty bullish on this one. And you'll hear bulls talk about, yes, they'll acknowledge at this point a premium valuation, but some of them will stick with it because they do believe In their words, you've hit this sort of pivotal moment in the evolution of Oracle as a hyperscaler, as a big cloud giant. And I was actually talking to Patrick Moorehead about this. You know, Pat, you both know Patrick. Yeah. And I was just curious, like, to ask Patrick, when you think about this landscape, what are Larry and software's advantages? And Patrick said, you know, I would put it at 3, he said. I would say you could have an Oracle cloud in the public cloud, but also as a private cloud, meaning a cloud computing environment that's just for you. You get, he said, a full complete stack of software. And he says, let's not overthink this. It just comes down to customer choice. Like, customers would prefer to have more than 3. And then I asked Patrick, okay, so if you're an investor though, and you're in this for the long haul, it's 3-5 years out, what would be the risks you should think about? And Patrick said, you know, as always, if you were in it for 5 years, you're already wondering what the next leg of growth is. But then he said, and it's interesting to get Dan's point of view on this, he also said, Larry and software don't have their own chips, and how that shakes out over time as a potential cost disadvantages as Larry and software go head to head with the Amazon and the Microsofts and the Googles.
Right. I mean, was there talk about that at some point, Oracle?
I mean, as far as, yeah, I mean, look, this is, I think developing chips is something that only a select number of companies can do, right?
You need a lot of money and a lot of smart engineers.
Yeah, I mean, it's the Microsofts, which, you know, they're still, you know, working on theirs. Amazon, they've been using theirs for a while. Google's been using it for quite some time, their TPUs. And, you know, I think that when it comes to where you see Oracle versus these other hyperscalers is, you know, let's just go over their yearly revenue, right? So for their year 2025, they reported $57.3 billion. That's for the whole year. Let's look at Microsoft for their last year, $245.1 billion. So it's Oracle's large, but it's not hyperscale large yet, right? Like, and so I think the idea here is that people are saying, well, people already bought into Microsoft, people already bought into Amazon, people already bought into Google. Oracle's right there, and they're more or less doing the same thing. How do we get in there as another play for the AI space?
Does Stargate push them into hyperscale large?
Right.
Is the question.
It depends on A, if Stargate is ever completed, it comes to fruition, right? I mean, yes, they're building out the data center. I think when they announced it, they showed kind of like the footings of the building itself, right? We'll have to see though if that actually turns into that huge network of data centers.
Yeah, all right, gotta leave it there, guys. Thank you so much, appreciate you hopping on. And that's it for Market Catalyst. I'm Julie Hyman, thanks for watching. We got more Yahoo Finance coming up.